Hello, Greg Lavelle here from Financial Square and Jackson Hewitt. Many life-changing events can impact a tax return, but there's almost nothing quite as big as retirement. Today, we will be covering tax tips to help taxpayers who are either planning for retirement or people who are recently retired. To start, the tax issue that retirees run into is not just the fact that they stop working their traditional job. It's much more complex and more so than just a few years ago when folks just had a pension and Social Security for retirement. Whereas today's retirees typically have a variety of savings and retirement plans, each with different tax issues. Let's get into my essential tips and advice. My first piece of advice to taxpayers is they need to plan ahead. In most cases, taxpayers need to plan years before retiring, and in fact, as early as when you first start working. Taxpayers that plan on retiring should keep detailed records up to and after retirement, more so than the earnings years. These records should include information about contributions, withdrawals, and distributions, and don't take any shortcuts or leave something off your tax return. If you do not understand something, find out. Leaving an item off can be just as bad as putting it all on as taxable when it might not be. No one at the IRS is going to lower the amount just because it was wrong. Retiree taxpayers can typically have investments in multiple retirement accounts, ranging from IRAs and individual retirement accounts, 401k, self-directed savings accounts, company plans, and plain old saving. A mix is a standard and proven best practice, but it can be confusing for taxes, so make sure you understand the implications for each account. Some of these accounts may provide tax-free income in retirement. Some allow you to take money out early. Others have requirements, and some savings is considered money that can be used at any time with little consequence on withdrawal and taxation. Next, many retirees consider working a side gig to earn through retirement while still drawing on retirement funds. This helps retirees remain active and involved, plus puts a few extra dollars in their pocket. But recognize that having a side gig during retirement has tax implications. You must pay taxes on your earnings even if you draw from Social Security and retirement funds. On that note, make sure you know how your Social Security benefits work. They are complex and could be partially or heavily taxable based on income levels. And even when these benefits start, you have many distribution options to choose from. Understand that some retirement income is considered tax-free, like a Roth IRA. Still, if it's misreported on a tax return as taxable, the IRS won't let you correct that mistake after a certain period of time. If you misreported, it stays misreported, and you may have paid too much tax. Lastly, make sure you understand how your state income taxes will impact your retirement, especially those who live in different states than the one that they worked for and earn their retirement funds. Taxpayers should enjoy their retirement. Work with a trusted Jackson Hewitt tax pro to answer all your tax preparation questions. Schedule an appointment today at jacksonhewitt.com.